Welcome to the latest episode of our podcast series for financial advisors. Today's episode is True Alignment, Advising Business Owners on Wealth, Significance, and Value. It's a conversation with Nick Hubert and Taylor Gentry, founding partners, Panoramic Capital Partners. I'm Jason Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
Advisory firms that work with business owner clients typically operate through a fairly traditional wealth management lens. The business may be the source of the wealth, but the advice itself often centers around investments, planning, and asset allocation. Yet Panoramic Capital Partners approaches that equation differently. Nick Hubert and Taylor Gentry are the founding partners of the roughly $450 million RIA, serving about 150 families with a 7-person team. And while they come from very different professional backgrounds, Nick with more of a relationship and storytelling orientation, Taylor from the analytical and private equity side, they've built the firm around a shared philosophy tied to what they call personal significance, personal wealth, and personal value. A big part of that philosophy, or the North Star as they put it, is applying some of the same accountability and long-term thinking frameworks commonly seen in private equity to the advisory relationship itself, not in a transactional sense, but in helping clients think more intentionally about decision-making, alignment, and outcomes over long periods of time. As a result, our conversation delves deeply into the private equity world, reframing how clients and advisors should consider this important tool as both a growth mechanism and a strategic part of their clients' plans. We talk about how that perspective also shapes not only how they think about serving business owners specifically, but also the role private equity should play in wealth management. Then we take a view of their long runway and how they and other younger advisors might see things differently about building firms today and why clarity of vision may matter more than sheer scale in the years ahead, and much, much more. It's a narrative that is refreshing and informative. So let's get to it. Taylor, Nick, thank you so much for joining. Walk us through your background. What brought you to the world of wealth management? Nick, let's start with you.
Sure. I think I got my first taste of the industry actually in a sophomore year of college internship, or I interned at Morgan Stanley here in Oregon. I studied finance and accounting at University of Oregon, and so had this kind of affinity for finance and markets and had that privilege of having that internship. So I had it early on in my career. Ultimately ended up setting my sights on doing investment banking and going that route, and did that for a short period of time. Yeah, ended up not going very long due to a medical reason, so you don't have to be that sorry for me. And ultimately started my career in business consulting before pretty quickly realizing that I wanted to get back to finance, back to investing, these things that just felt like core competencies and that thing that you keep coming back to when you're alone in the middle of the night thinking about stuff. It was always that, and just had this desire to work with kind of smaller units than large corporations, which is great for wealth, where you get to work with families and small businesses. And so it was just a natural alignment that took me back full-time to the space in 2016.
I like the framing it through the size of the unit you're working with and having more of an impact on the family. Taylor, what about you?
Mine's a little more circuitous, if you will. Been a couple of years in investment banking, so you can be sorry for me. So yeah, Nick and I met in undergrad at the University of Oregon. had the opportunity to work in this investment group together where we were investing a portion of the university's endowment. And like Nick, interned in wealth management and kind of walked away from it going, boy, that's boring. I don't really like that. And so moved to New York, cut my teeth in banking for a couple of years. And we were working, so an investment bank for context, helping companies raise debt, raise equity, and with mergers and acquisitions, we were working with huge companies. So the Mattels of the world, the largest toy company in the world. Like Nick, realized, hey, I want to work with smaller companies that we can get our arms around a little bit better and be more helpful with and have a bigger impact on. So spent about 10 years with a private equity firm in the western half of the US. And we invested in companies in what's referred to as the lower middle market. So companies doing 50 to 300 million of revenue. And we would invest in those companies, grow those businesses, and then look to sell them. And awesome experience, learned a ton, got a bunch of experience around how to invest in companies, how to grow businesses, and then had the opportunity to step into the CFO seat of a couple of different operating companies during that time. And it was just a great kind of learning ground, but also to see a whole bunch of different situations. And Nick and I have always invested in things together. We've worked on things together, and we've always wanted to work together full time. And a few years ago, the stars really just aligned to say, hey, what would it look like to create a differentiated offering in the wealth space where we can blend my background on companies, transactions, how to grow and scale, and all those pieces, and really marry that with the wealth management piece. And Nick will get into that further, but it's just a really unique way to partner with families in companies that are smaller. We can have a really high impact experience with those families and really move them through their life journey, if you will.
Yeah, there's a lot to unpack there, and we'll get to some of the elements of how you run the business today. First of all, you can't fool me by using a toy company as your example to make investment banking more interesting. I'm just kidding. Actually, my real takeaway there is you have a skill set that is incredibly relevant in the current wealth management ecosystem, especially in the model you're currently in. So let's talk about that a little. Tell us about your current chapter, which is Panoramic Capital Partners. Who do you serve? What types of clients? Give me some perspective on size as well.
I'll maybe take this first. Taylor can do the PE background guy and give you a bunch of numbers. I'll give you the story and see if we can piece it together that way.
I get the impression you guys use that line a lot.
Oh, no, that's the first time. How'd it land? Yeah, Jason. So I spent 8 years at our prior firm with our third founding partner, Andrew, and he was at that firm for 30 years. And so we've got this kind of core DNA that we've always carried of serving high net worth families in a very holistic and deep planning-based capacity, which I think a lot of modern firms say that. And so that's not necessarily that different, but it is a DNA that carries through. When we got struck with this vision of launching Panoramic, of what inspired us to build the firm, it was, as Taylor outlined, around this idea of how do we partner with entrepreneurs and business owners more holistically across their entire entrepreneurial journey, not just around the exit, as is so often where the gravity of the conversation sits. And so our firm kind of vision and inspiration was all around that. And since launching in kind of May of 2024, it has been about how do we bring that vision to life with a different business model. And to your point, there's a bunch to unpack there, but that is ultimately the founding vision of what we're trying to build here overall and what inspires us every day to say, how do we, as Taylor mentioned, bring the kind of combination of skill sets to bear in a way that allows us to be a better partner along the entirety of the journey, as opposed to just towards the end when assets traditionally show up, so to speak. So that's a story from a vision perspective. Taylor, I don't know what you want to add to that.
As Nick outlined, it's the ability to work with folks throughout the life cycle. So in private equity, you invest in a company, you work with that management team for 3 to 7 years, and then you sell the business and move on to the next project or deal. And really, it's the deal mechanic that is the value creation. Whereas with what we are building here, we have the opportunity to really step along the journey with folks when they are in the early phases building what we talk about as the middle phase of allocating, and we'll talk about this further, and then really the third phase of stewarding capital along the way. And it's a life cycle or entrepreneurial journey that we're able to be hand in hand with folks over decades, opposed to measured in 3 to 5 year spans.
So it sounds, and you've both kind of touched on this now, your different backgrounds, you view as very much a positive because it gives you, Taylor, the more in the weeds analytical perspective. Nick, you're probably more the storyteller. Do you find that to be a benefit when you're running your firm every day? And are there instances when it's a negative? Is there ever a time when you say, Taylor, you just maybe more for you, not coming from this world, you don't speak the same language?
Do you want me to drop off the call so Taylor can be honest and he can give you the scoop and then he can jump off and I'll give you the scoop?
Jason, we talk about that a lot. Honestly, I think it is atypical for someone with my background to step into the wealth space, maybe more so. And we leverage that because we have the ability to work with folks on how do you drive value in the company? How do you set the business up for a potential sale, exit, or transition internally? But this business, historically, we've talked about it as almost like two tracks. You have the Taylor on the quote unquote business consulting or the business work track, and you have Nick on a wealth management track. It's really not the case. And really the power is the ability for these two pieces to come together. And there isn't a conversation we have with clients where those two perspectives and backgrounds or contexts aren't married into one to create really, truly holistic advice. And so Nick will probably tell you otherwise, but I haven't seen an area yet where our two backgrounds has been a negative. It's actually been immensely positive. And then on top of it, in terms of kind of building out the firm, Nick is more of the traction visionary and I'm more of the traction implementer. And what's amazing about it from our perspective is the partnership we have allows us to A, recognize that, B, name it, and then C, leverage it in terms of being able to dole out duties and maximize our success together.
Nick, anything you'd add?
I think that's all right. I mean, Jason, your question was from an operational perspective. I think a lot of Taylor's view is from a client perspective, which is spot on, that the kind of overlap of that is really helpful for clients. And I think what allows it to be a different experience for them internally, operationally, I think where you could see friction there amongst partners with differences. And I think you do see that. And at the same time, Google was the one who did team research 15 years ago, where they put out what you really want is similarity in vision and differences in skill set when building a team. And so I think we've been intentional about that. And it's been really helpful for Taylor and I functionally met in a quasi-professional setting back in 2011 and developed a friendship quickly. So we've got that deep level of friendship that underpins all of it. And same with Andrew in our time working together. So part of it is there's just such a strength of relationship amongst us that we give space for each other's differences and look for those as assets as opposed to negatives. But in some sense, beauty in the eye of the beholder, as is the case with anything.
Yep. I appreciate you adding that context. I'll be honest that when I first encountered your firm, my reaction was your core value prop of serving business owners is not all that differentiated. And then I learned more about the way in which you serve business owners. Can you talk about that? Because a lot of RIAs, a lot of advisors in general, but then I think more specifically, a lot of RIAs would say, we service primarily business owners. Tell me, how do you do it in a way that's different and meaningful?
I'll take a first stab at that, and then Taylor can maybe add on with specific stories. The wealth space is an awesome business, and it's a place where it's very difficult to differentiate. And so we think a lot about that through the lens of how do we grow this business well for the long period of time to create opportunities for clients and employees. And so we spent a lot of time thinking about that, not only for the sake of differentiation, but also how do we actually just continue to add value to clients? Because if we add value in a different way, growth will take care of itself. I'd say one way of cutting that is to revisit the mission is through this idea of, okay, if I want to be a partner along the journey, it's about more than a single transaction, more than a single exit, whatever that might be, or a series of transactions as well as often created over a series of transactions. It's this idea of how do we focus on wealth creation and driving business value as the engine of wealth creation for entrepreneurs and what we call personal significance, which is the life of the entrepreneur. And so there's a next click down framing of our framework that we work through that lens. And I think the most important piece for us has been how do we build a business model that actually brings that to life? And that's the trick, because we can say that. And if we basically still just operate out of an AUM-based or an asset advisory fee-based business, the reality is my incentive is still towards getting assets out of the entrepreneurial environment, so to speak, into a place that I can manage them, which may or may not be the best thing for the entrepreneur based on where they are at. And so our kind of current work continues to be around how do we build that business model? So layering in different ways of engaging, whether it's a retainer fee or some other way of engaging, so we can start earlier when assets aren't there and actually encourage the entrepreneur, no, keep reinvesting in your business. It's your highest rate of return right now, and it's where the investment needs to go. I don't want to have a conflict in giving that advice. And so I think step 2 here has been building that business model from an actual engagement perspective to enable us to enact the vision. And then I think the third piece is how do we then build tools that are different than just evaluating pre-exit planning, and as is so often the toolkit, but actually saying, okay, what are the value drivers of a business? And this is probably where Taylor has a lot more to add because it's a 101 of the PE model, but how do we take the mission and vision of an entrepreneur, what we call North Stars, translate those into value drivers, ensure those tie to strategic initiatives in the business, ensure it ties to reporting, and ultimately how capital is allocated between the business and other investments. So then that's our kind of toolkit that we continue to build out to deploy the mission through our business model with tools that back it up. So that's how we frame it right now. Taylor, we can share stories about how that's come to fruition to create different outcomes.
Taylor, I'd love to hear that. Let me just add maybe my understanding, because this is what helped me, I think, to really understand how you differ. And Nick and Taylor, correct me if I'm wrong. It sounds like the typical advisor thinks about an entrepreneur, a business owner relationship as the next liquidity event in most cases. And you take the viewpoint that it's a journey, in some instances, 30 years in the making. It's not even about the liquidity event might come. That's beside the point. Is that a fair summary?
Yeah, we talk about it as a growing business is a healthy business, a business that is creating incremental value and adding to the multiple in terms of how the business is valued in the marketplace is a healthy business. And so whether you are going to sell that business or retain that business into perpetuity, let's make a really valuable business and grow a very healthy business. And that's what we do with clients. Nick laid out the North Star framework. And so how do we actually go about engaging with folks on a practical level? It does start with the North Star framework. It's got 5 steps to it, as Nick outlined, in terms of defining the North Star, where we're going, what we're trying to do. And that's across those 3 pillars: personal significance, personal wealth, and business value. And that personal significance has to be held at that same level. Otherwise, we find folks that are mid-50s, their business is crazy valuable, they've got a lot of dollars, but their family life isn't where they want it to be because they didn't take care of that along the way. And so we lay out a placemat that says, hey, these are the North Stars that we are aligning on and coming back to every month when we work with these owners. We then push that into, okay, what are we trying to do on the business side of the equation? Let's lay out what is going to drive the value of the business from a multiple and enterprise value perspective. We push that into a set of strategic initiatives that is tactical. Who owns what? When's it getting done? And are we red, yellow, or green on it? We then build out a performance reporting package with folks. And so that is a monthly reporting package that says what happened last month and what operational data are we looking at to be able to improve the business month over month and get a good feedback loop going into the company. And then the last piece is around capital allocation that Nick mentioned, where the business generates $1 million. Where's that capital going? I think there's a lot in there and it's really deep, but if you zoom all the way back out, it's take a private equity style playbook where private equity firms come and invest in a company. And what do they do after close? They put in place good financial reporting, good operational reporting, and then hold the team accountable to that reporting and those results on a monthly, quarterly, and annual basis. And so this is not rocket science or something that's never been seen before. It's just most business owners that have never experienced this private equity world don't have access to it and don't know how to go about doing it. It's a relatively long process to get that installed with companies and with teams to really dig in and understand it. But it's building out those packages to be able to say, okay, what happened last month? What changes do we need to make? And what are we doing from an initiative perspective to drive the business forward? So to Nick's point, it was previously, this was all about liquidity planning, or from a wealth management perspective, it's about the exit. This is about how do we make a more valuable business along the way? And that's going to be good for the entrepreneur as they move through the journey.
When we were around the dinner table, the proverbial dinner table, creating the vision of this firm, it was around this idea of the silver tsunami and everything that everybody reads in the headlines of this massive wave of transition, this generational transition of business ownership that we could help facilitate. So we launched with that thesis in some sense. In addition to this broader journey perspective, we have gotten to this place by following the market and listening to what entrepreneurs actually want through the big unlock was honestly in a deal process with one of our clients where we realized this is a great deal. This person's going to put a ton of money in their pocket, secure their future. And it's completely the wrong outcome for the entrepreneur because it's thinking all about the deal, not thinking about what this person didn't want was an exit. They wanted a different relationship with their business. And that required, what do you actually want out of life, that personal significance piece? And it required, hey, if we can actually create a layer of team members and reporting that allows you to manage this like a board chair would do, as opposed to a highly engaged CEO, that's actually what you want. You don't want out of this business. You want to still have this be a huge rock in your life. And so we ran through that door, said no to the deal with them, and have been building the infrastructure around this. And that was the unlock and aha moment for us. There's something bigger here. And that's what then inspired, in some sense, the broader build out of the toolkit. But I think puts more meat on the bone of like actually saying no to a deal, which is not the classic kind of wealth manager outcome, to get to a way better outcome for the client. And it's ultimately still an awesome client for us as a firm and somebody that we can go build with for the next 20 years. So I think just like telling it through the lens of a story that's different than what's normal, so to speak, is a way to frame that up.
It's such a hyper focus on a fairly long-term and honestly nebulous potential outcome. You don't have certainty. That, I think, is why most advisors would prefer the near-term liquidity. I mean, it's not a secret, right? You can bill on assets, firms are incentivizing it, and it's a pretty direct recipe to net new asset growth. But it's certainly a refreshing point of view. It resonates with me. I'm wondering if it's resonated with clients and prospects. I guess what I'm asking is, do they feel that this is something different than the typical wealth management experience for this type of client?
Yeah, too. I think tell that story of like that guy who said, I've had this, but I felt alone. And like, I think that story of partnership you tell pretty well.
Yeah. So Jason was actually that same client. He had a investment banker, a wealth manager, attorney, and a CPA.
Yep.
CPA said, the deal's terrible. You shouldn't do the deal. Investment banker's obviously incentivized to do the deal. And so he's saying you should do the deal. That's how he gets paid. He had a wealth manager who was silent, and he had an attorney who was just pushing paperwork.
It's like the start of a bad joke.
Yeah, no, seriously, it's pretty remarkable. It's like this guy did what he was supposed to do. He put the team of resources around himself. He got professionals in the seat. It's that no one could connect the dots of all four of those people because they haven't sat in the seat of those four people. And so it's really resonated because there's an ability to see a bigger picture and connect these dots and say, okay, this investment banker is saying X because of A, B, and C. And the CPA is saying it's a bad deal and that it's not a market deal. It's 100% a market deal. This deal is right down the fairway in terms of what the market should value your company at. And they just don't understand how the transaction mechanics should work. And so it's worked really well from that perspective of being able to be the quarterback or centralized point or personal CFO for folks in understanding where interests lie and also being able to think about what they are pursuing in a bit of a different lens. I think the second piece on that is, where is it resonating for folks? I think that there is a gap in the marketplace that we are still working to close. And that gap is that business owners do not know what this monthly reporting package looks like. They do not know what really good reporting on their business looks like in terms of they have always run you've got a business owner, they've run their business for 10 or 20 years. They have a pulse on the business from their gut feel. That does not mean that the business has been optimized, is ready to take it to go to the next level, or is ready for a transaction and go through a transaction, because they have not done the work on the back end to understand the moving pieces of the business at a granular level. And this reporting package, we oftentimes get this kind of confusion around, well, I've got a temporary CFO or a controller or XYZ. And that is very different than what we're talking about. Well, that is all accounting, close the books, have clean numbers. What we're talking about is, how do I marry operational data in the business? Number of units shipped, number of jobs completed, time on job, operational data to the financials in the business, so I can then go make adjustments operationally on how to improve the business and continue taking steps forward.
It's very clear. Nick, anything you'd want to add to that?
I just say it's easy to still cut that from a deal lens and say, look, if you are when an investment partner comes to evaluate a business, to sit in their seat for a moment, they're going to look at the replicability of what that leader has done without that leader still in the seat. And if there's so many businesses are still reliant on that person, and this gets talked about as processes, reporting systems, that ultimately results in a discount to the value of the business, because although it can be viewed for the leader, it's like it's that control thing that entrepreneurs deal with. It's what made them good. It's what got you there. And so that transition is really hard. And that's important from a deal lens because that does a direct impact to value. And to widen out the scope beyond the deal and to think about the entrepreneur's life, this goes back to the dynamic that a lot of times entrepreneurs look for the exits because they've built something that it's now owning them. And what they've built is not resulting in the life that they want. And so how can we use this system to actually change that relationship, as I mentioned earlier, with the business so that they can run it more like an executive might and get out of the knife fight, so to speak, that often is how this can feel for a lot of folks, even for pretty large businesses. It can just feel like you're a firefighter, you're in a knife fight, like whatever you want to use for that terminology. I think it's as much about creating a different life outcome and different relationship in owning and leading a business as it is in driving deal value.
Taylor, maybe I'll ask this of you. Forgive the question, but private equity, I think in our space has a little bit of a negative stigma at the moment. I don't think that's true across the board. I think people appreciate generally the need for capital, and there are certainly benefits of private equity, but I'll say as a whole, advisors are, let's say, suspicious of private equity. You ever get that pushback? Does anybody ever view your experience or the way you position the story as a negative?
I think most people that we talk to don't know what private equity is.
Yeah.
They may have seen it in the headlines. They may have some sort of connotation around it. They won't come out and say that they don't like it. They don't know why they don't like it. The average American business owner, they don't know what it is or what it means. So yes, you do have to fight that because of the headline piece around private equity, bad actor, ABC, and that's what gets the headlines. I think what private equity is really good at is taking a business that is not optimized or not running on systems and processes that it can run on. And again, it's not rocket science, it's not crazy hard. It's just the private equity world has created ways to install systems and process that improve the value of the business by way of providing visibility to financials and operations in a way that the owner previously didn't have. And so for us, we view it not by any means as the end all be all or the answer. There are clients we've worked with that have taken private equity capital and grown, successfully executed on some acquisitions and then exited again. There are clients that have evaluated those transactions and said, hey, not for me. We are actually fairly agnostic to it. What we really spend a lot of our time on is, what are we solving for? What's the end game? How do we use this private equity transaction to get to where we're trying to go? And is it what we want at the end of the day? Because the reality is, if you're going to stay on and run that business with private equity investment there's a higher expectation on what you need to do Monday morning than when you owned it yourself and it was a little bit of your personal piggy bank too.
I love it because you bring it back to the North Star concept.
Yes, that's exactly right. It's what are we solving for and what game are we playing to be able to get to where we ultimately want to go. And for, as Nick mentioned, that client that turned down the deal, it was a private equity investment. We got very clear with him. Hey, here are going to be the expectations. You will have a monthly financial reporting call. You're going to have quarterly board meetings. Yeah. These are things that need to happen in this business to be able to upgrade the management and cadence in this company. You don't have to do it all tomorrow, but that is how you make a more valuable company, is installing some of these systems, process, and cadence. And so we're working with him now on doing that just in a private context instead of in the private equity backed environment.
I think there are three things embedded in this. I'd say number one, to Taylor's point, like this is a massive black box in some ways by design, right? Wall Street's had not a great reputation for a very long time of putting things behind the paywall, so to speak. And so we think a lot about our job as empowerment and education of the entrepreneur. Yep. Yeah. And so part of it is just, number one, how do we just demystify this thing and name things and take away the good or bad, because it can be that, but it should not be that from a core basis. That's number one. Number two, a lot of entrepreneurs feel like they cannot get access to this ability to professionalize or level up or whatever these things are without bringing on that investment partner. And so part of our motivation is, how do we actually bring this skill set in without needing to bring on an investment partner? because oftentimes that investment partner comes when you're done. And so you don't actually get to experience it, right? So that's number two. Number three is, Jason, part of your point earlier was like, there's still a trap here of potentially being able to get motivated primarily by the exit. And so again, that gets back to our business model, making sure our pricing is right, all of that good stuff. And it's also the reality that a lot of businesses, if you just look at a very broad scope of American businesses, a lot of them don't have value in the marketplace in a massively material way and or won't exit in a traditional way. And so the wealth creation journey then becomes much more of a conversation of how do we manage the balance between investing in the company and distributing out of the company to invest elsewhere, because we should actually be creating investment assets along the way. Because when you get to the exit, there's no better power position at the moment of exit than already having financial security to some degree and giving you choice in the right deal, not the highest and best deal because you need to fill the piggy bank for retirement.
I just want to be sure to ask, because you did mention a couple times your pricing structure. How have you set it up so that you can be more kind of agnostic about this as opposed to the typical? You want to talk about it for a minute?
As it's structured now, it starts with a retainer earlier on where we were working, like when, as Taylor mentioned, we are going deep in the operational build of the business. We will do that on a monthly retainer. We're engaging consistently. As assets get built up, and if assets get built up, we start to chew that retainer down as assets go up. I think what we are ideally trying to figure out, and still honestly have not figured out yet, is how do we get to parity so that we don't create I want to be able to work agnostically with a client to say,
I love it.
Regardless of how I'm engaging with you, that's the goal. So I'd say we haven't cracked the code on exactly what that is yet, but mechanically we've got the levers to pull to say how we price and move that retainer down is basically allowing to keep it at par, so to speak, for the client, and allowing us to say, I'm here to engage in making the best wealth creation outcome for you along the way, whether that's investing in the business or investing outside the business.
I think that's the right recipe. I agree. The levers can be fine-tuned, but to me, that's the model you want to create, where you can credibly look your prospects and clients in the eyes and tell them our job is to serve you in the best way possible. We're sitting on the same side of the table as you. I want to turn this inward for a second, the home cooking concept. So M&A within the RIA independent space is obviously a hot topic. Have you thought about it? Do you think it's a critical part of a potential growth trajectory of a healthy independent firm? I'm curious your perspective. I feel you probably have, Taylor in particular, probably have a unique lens on this coming from the world you came from.
Yeah, Jason, I think if Nick and I wanted to put as much money as we possibly could in our pockets as fast as humanly possible, it's a pretty easy recipe. It's go get some private equity capital backer, roll up a few RIAs, get to a few billion of AUM, and then sell it to the next private equity firm or roll it to the next private equity firm. Do that a few times. We'd all make plenty of money and go on our way. We've been really intentional on this front. And Nick and I talk about this is what we want to do for the next 30 plus years. And really being intentional around building a business that has that enduring nature to it. Second, you take private equity capital on, you are on a shot clock to some degree. Yes, you're trying to build a best business, all of those pieces, you get cadence, you get capital. There's a ton of value there, but you are on a shot clock that is not a shot clock we're trying to get on at this stage. I'd say we opportunistically are looking at acquisitions. So we think about it, and Nick and I talk about it all the time. How much of our time should we be spending on acquisitions? And we think of it as 80-20 or even 90-10, 80% or 90% organic growth focused, 10 to 20% acquisitions focused. And so we're actively evaluating those consistently and see deals on a monthly basis that we look at and evaluate. But it's less of the focus today than it could be down the road.
And Nick, do you think of that when you guys talk? Do you guys call that your true north? Do you think it the same way you coach your clients and prospects to say, for right now, it wouldn't be the right move for us to take private equity capital and to do this acquisition roll-up strategy because A, B, and C are more important for us?
Yes, I think if we take our life North Star, right? For Taylor, I'm speaking for Taylor, but we're close. And so we share this of, to Taylor's point, the life outcome of scaling that quickly with that type of capital backing is likely to create a life that I don't actually want, that's not good for me, not good for my family, and honestly, not good for our clients at this point. And so that overrides in this case, even though the wealth North Star might say, hey, absolutely do that. At some point, something has to win. And so that is true. At the business side, as the North Star is motivated by this mission of the entire entrepreneur journey, the worst thing I could do is shortcut my ability to be on that journey for a long period of time. One of our friends in this space says the best thing I can do for my clients is still be in this seat 30 years from now because I've lived a good life that enables that. And I think that's spot on for us is like everything. It's so easy in today's world to be consumed by short-termism. And we are intentional in ensuring that we don't succumb to that while still recognizing, to your point, I mean, you're in this all day, Jason, right? There's a massive opportunity in front of us to be thoughtful about how our acquisitions fit into this. And I think we want to be open to that in a way that ensures we just don't lose the core of the goodness of what we're trying to build.
I think that's the right answer. The only wrong answer in my mind is we're not open to this or we're closed to this. To not at least be opportunistically aware of the dynamics in the market, I think is naive. But also, I'll be honest, Nick, like when I think about the concept of the North Star, I have a hard time imagining, because we use a similar concept when we counsel advisors. What is your true North or your North Star and your best business life, whatever you want to call it? And to me, it does include absolutely the personal piece. I think it's hard to define it only on the economic verticals because, I mean, I think about this for a transitioning advisor. Almost never is the conversation about crunch the spreadsheet and get us the biggest check possible. It's, yeah, sure, transition capital is important, but we want a better work life and we want freedom to market and blah, blah, blah. So to me, I think it's completely fair way you two are looking at it, at least for now. And I assume you reserve the right to revise that opinion down the line.
I think acquiring for size and scale is as often the headline is, yeah, we're not into that at this point because I think, and yet, hey, if the right acquisition with the right people came along in that, we'd be extremely excited and would move very quickly to execute on that. So it's a little bit of both and.
Yeah, Jason, I think it goes without saying, but my background on having done a bunch of transactions of businesses like this, it's a natural fit for us to have this as a lever. And so we are looking at deals. We just haven't prioritized it as the top priority.
I think also where you are, 2024 was the launch of the business. It's pretty common to see, all right, let's kind of nail this. Let's get our feet under us, client service model, and then we'll start to think about that down the line. A couple other things I want to ask you about running an independent firm. Anything that this is a pretty glowingly positive review, I think, of your ability to service clients, your ability to grow and to build and run the business that you want. Has there been anything negative that you haven't enjoyed about running and operating this business? Other than working with each other, of course.
No, I was going to say, I'm like, can we get Taylor off the call again?
Lisa, maybe I'll take a first cut at it. I think for both Nick and I, it's just the administrative components of running an independent business that we don't enjoy, candidly. I don't think many people would. That said, you come full circle and it is a pretty glowingly positive review of running an independent business because we get to run it in the way that we see fit. And oh, by the way, we use the same things that we use with our clients, right? So the value drivers we've talked about, we have a value drivers worksheet. We refresh it every 6 months. Nick, Andrew, and I get together every 6 months and we're 18 months into this thing and we've already got this kind of cadence and system to it, if you will. So I personally really enjoy the running the business piece of it from a macro perspective. I'm responsible for running our fee billing and running the math on all that and getting that done, for example.
I think that's actually a very thoughtful answer. And I appreciate you saying I enjoy running. I feel the same way, by the way. There's some elements of running a business that I think are immensely fun. I think it gets painted with this brush of, running the business is the hassle and I want to work in the business. Agreed. Nobody likes invoicing and accounts receivable for the most part. But Nick, what are your thoughts on this?
Yeah, I think mine is different a little bit coming from a different background where we were like, it's easier for me to sit with the rose-colored glasses of the joy of the freedom that we have in this model. And at the same time, when I'm counseling folks who are like talking with folks or mentoring folks, younger people who are thinking about, okay, I want to go start my own thing. I'm like, hey, it's like, I'm the same way. I want to look in the mirror and think I'm the boss or I'm one of the bosses and we get to go build this. And then the reality is, at the end of the day, if there was something that like you didn't want to do that had to get done and you didn't do it, you got to look in the mirror and be like, well, you're the boss. You didn't do it. Like it's the both sides of the coin that I think a positive negative cut is one way to look at that because it can feel that way sometimes. And the reality is every job has 20 to 30% of it that you just don't enjoy doing. And that's totally true.
That's why they call it work. That's why they pay you.
They'd be pretty quick to point out that I'm the one of the partnership group that like they're going to have to chase for a smaller administrative item. Because I honestly just, similarly speaking, don't enjoy that. I want to go talk to clients. I want to go focus on building what we're building. And in finance speaks, it is a higher beta to just the all-encompassing realities of running a business that is really hard to underscore without being in the seat. And yeah, there's definitely 20 to 30% of that I would love to wave a magic wand and say I don't have to do anymore.
Yeah,
But
I appreciate
you can't
the
have one
honesty.
without the other. It's both sides.
And I think it's getting easier, and I think it's getting more offloadable, and some of it probably gets more, in some ways, more offloadable as you scale, but then you get a new set of problems probably too, because you're dealing with bigger. So it's a never ending. I think most business owners would agree with that. And you said it well, you take the good with the bad. And overwhelmingly, most people we speak with in the independent space feel as you do, which is, are there things I would prefer to offload or that I would prefer not to do? Of course, but that's almost just the price you pay for the freedom and for doing all the things you want to do. Two more questions that I want to be sure to ask about, where this has been a great episode. One is AI. Need to know your thoughts. Is this coming for our jobs? Do you think your firm is positioned to capture either asset flows or also just to leverage this technology and use it to serve clients better? Just give me your thoughts.
I think in some sense it would be irresponsible as on like people this early in our entrepreneurial journey and thinking about how do we optimize what we do for clients to not be engaging with AI in some way, shape, or form, at least in an evaluative posture. So we are actively in a bunch of different ways, whether it's buy it off the shelf or build it, continuing to find ways to think about not only how do we drive efficiency, because there's an obvious like surface level dynamic of if I can save time and spend more time with clients, like that is a good thing objectively. And there's this deeper dynamic of if it can amplify what, actually back to your prior question, if it can amplify what I'm best at and enjoy and reduce what I don't enjoy, that's a massive win. And I think we're like on the surface of seeing that. That's the opportunity. We are motivated by that and pursuing that. And at the same time, I would say an operational principle that really is important to us, and you can almost call it a North Star within the business, is client security can never be put at risk for the sake of our own growth, our own efficiency, or anything else. And there's, I think, still a question mark as to how we think about trusting this. And so we are very cautious as we think about, we will never try to move so quickly on any technology, whether it's AI or otherwise, that we risk our clients in some way, shape, or form. Because the reality is we are also in a context where AI is, when polled, one of the least popular things happening in the world today for the average American. And so there's no kudos here for being a leader.
I totally agree. The first mover advantage here is slim to none.
Yeah, you don't want to be the one sticking your neck out on this in our industry. There's not, and yet there's still, it is objectively has the potential to be better for the clients. Navigating that, I think, is messy.
I think the only thing I'd add, which is pretty short, is the use of these tools has the ability to create a better deliverable for clients on a more consistent basis. And marrying that with exactly what Nick just outlined around the risk is really the magic piece here. And so I think to the extent we can get it implemented effectively with the security, but also with, this is going to result in a lot better outcome for clients across the board. That's a pretty attractive objective to go after. And it's pretty exciting to be in the industry with that now on the kind of forefront in terms of ability to improve that experience over time.
Yeah, no, it's a good color to add. I want to end here with a potential HR violation, but you'll forgive me. I'm not going to ask about age, but you are clearly both relatively young advisors. And this is a hot button issue in our industry, the idea that there are not a lot of talented young next gen advisors at a time when a lot of Gen 1 or older advisors are retiring out of the business. So what would you say? I think one of you made the comment earlier, like it's not necessarily the coolest industry to go into at 23 years old, right out of school. I think more commonly people go into sales and trading, investment banking, or some of the other finance verticals. What would you say to younger folks interested in wealth? And maybe I'd ask also, do you have any thoughts on how we solve this like next gen talent crisis? And if you're both secretly 90 years old, you can just do it. Not applicable. And
you talking my internal age or my actual age? Yeah.
Why don't you go first?
Yeah, go ahead, Taylor.
I think there's a couple, two kind of threads here. The first is it's not a sexy industry to go into and not as sexy as like an investment banking, private equity kind of shtick, if you will. I think from my perspective, it's really important what you're working on. The ability to be in a firm like what we are building with the diversity of work that is available is a little bit like the world's your oyster, and we're designing it with that in mind. For Nick and I, the ability to work on many different situations throughout the day and throughout the week is actually why this business is so attractive and interesting and why we want to do it for 30 years. And so we're building with that context. And so in some ways, it's almost like a plug for younger advisors, the ability to work in a firm like what we're building, where you've got this diversity of work that is not just trading stocks and bonds or, just Yeah, spreadsheeting or just financial planning. This is a much broader expression and experience than what I would call quote unquote traditional wealth management. So I think that's the key on that front. And then on the talent development side of the equation, if you will, this AI thing is going to be a big question mark. And what I mean by that is there is significant training that will be required in, call it traditional wealth management, or the firm we're building with regard to folks' ability to actually learn when you can plug it into AI and get an answer that you don't have to critically question or think through. And so there's going to be a significant kind of learning curve for folks that we're going to have to continue to train and educate on in order to produce talent that can be long-term sustainable and beneficial for clients more writ large.
Nick?
So, well, first and foremost, we haven't given our third partner enough airtime, right? I think we have a tremendous benefit of having a multi-generational team at the partnership level where he's in his mid to late 50s and can bring that additional experience to bear when and as is necessary and as important, because investing is an experience business and a lot of clients want that. And so the power of that matters. And I think that actually speaks to firms being willing to think of partnership at that level, that partnership is not reserved for just once you've been there for a long time. So I think it's getting at like, how do you share ownership earlier, do it in a way that is actually giving people a stake in the outcome and allowing that elevation to happen. I think that's number one. Number two, honestly, the existence of people like you and your team that your family has built over the years, Jason, is awesome. And because of the ability for you to help people navigate and see how easy it is to actually run this business and build this business in some sense. And that's in the broader spectrum of having seen, we work with so many different types of companies. We sometimes say our business is so much easier to run, and it has come so far with technology and with people like you who are providers to us to allow it to be easier for us, so to speak. That's a big deal. I think that should be talked about more, that there is a massive, what that allows is more time to, as Taylor mentioned, build what you actually want, because you can outsource the compliance piece in a major way that allows you to not spend as much time on that as you used to. So I don't think that gets talked about enough. And I think if you just zoom out and view this in the perspective of post 2020, there was this massive movement of entrepreneurship through acquisitions and people looking at this idea of how do I get the life I want by way of not having to be on a 2-year clock to go to the next job, have something that I can have a long-term impact on, where I get to build something and have employees. This is the perfect space for that, because it's such an awesome business where you get to work so intimately with people and clients and their life outcomes. They're, again, relatively speaking, easier businesses to run relative to what's out there. I'm just baffled by the fact that it is not seeing a larger wave of younger people coming out of these more quote unquote traditional paths and seeing this as an awesome place when they're willing to go buy an HVAC company. This is so much easier than that.
Oh,
so
man.
honestly, I think part of it's just telling
Preaching
the
to the
story.
choir.
I think part of it's just we all live, coming from being in the space longer, we get stuck in our wealth management lane. And I think it's easy to then nitpick and get stuck in there. But when we take a more global perspective, it's a massive opportunity that I hope more people take advantage of.
Thank you for highlighting that. We call it the ecosystem of support for financial advisors, and it's gotten so much more robust through the years. And a lot of times people focus on the negatives of compliance burdens have gotten heavier and competition has gotten fiercer. And yes, that's all true. But the flip side is the point you just made, Nick. So I appreciate you bringing that up. Any last kind of words of wisdom you'd want to share with our audience? This has been a fantastic episode, and I can't wait to have you back on to revisit the growth trajectory.
Yeah, I'd say just thank you for the time. We've enjoyed, we'll plug the podcast. We've enjoyed you guys for a really long time, and being able to have the resource of what you guys have built is actually, in our partnership meetings, we're bringing you guys up with some consistency. So thank you for the kind of gift that you are to the industry and continuing to create opportunity for folks like us to come on here.
Thank you so much.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.